Bobby, look at me. This year, I'm giving you $1,000.
Yeah? When can I get it?
Exactly. When?
The Trump account's $1,000 seed for your child can trigger complex federal tax liabilities. Yes, because they're IRA-style, so withdrawals can become taxable later, and one of 12 traps can wipe out that 1,000. In this video, I'll show the exact limits, investment restrictions, and how withdrawals can create ordinary income and potential penalties if mishandled.
Yo, tax and borders, what am I supposed to do now to keep my kids' money away from that guy?
Here's the trap. IRA-style rules can turn growth into ordinary income later, and mistakes can add penalties. Under Internal Revenue Code Section 530A, these accounts follow a traditional IRA framework, with strict custodial rules during the growth period. Your timing matters because contributions generally cannot be accepted before July 4th, 2026, regardless of headlines or sudden hype.
And how am I supposed to get eligible for that $1,000 you were just talking about on the screen?
You may establish the account and elect the pilot contribution using Form 4547 with your 2025 federal return filing. Activation requires an authentication process through Treasury or its agent, and you must complete that step to activate the account fully. During the growth period, distributions are generally prohibited except in narrow categories, so liquidity planning must assume locked by default. If a distribution occurs and no exception applies, an additional 10% early distribution tax may apply under standard IRA rules. Your aggregate annual limit for most non-pilot contributions during the growth period is capped at $5,000 per child. When the beneficiary reaches age 18, the account transitions to standard IRA treatment, providing greater flexibility than during the minor period.
Anything else?
You should recognize that this is an IRA framework first, with custodial modifications and restrictions unique to the growth period. And assume ordinary income rates apply to taxable distributions, because IRA-style treatment converts gain into ordinary income on withdrawal. The One Big Beautiful Bill Act establishes a pilot contribution for eligible birth years, but you still must elect it correctly.
Am I allowed to choose any asset for this deposit, or is the government going to tell me what I got to do?
You cannot choose any asset class because sector indexes, leverage, and high-fee products are excluded by the program's design. Federal guidance limits investments to eligible low-cost index mutual funds or ETFs, tracking broad U.S. indices with strict structure rules. There is also a hard cost guardrail. Eligible investments must stay at or below a 0.1% expense cap. Managing these assets incorrectly can create a cash flow squeeze that impacts borrowing plans, including a HELOC or refinancing strategy.
Wait, a card just popped up saying my paycheck is actually smaller, and I definitely need to watch that soon.
Employers can make contributions under special rules, and those contributions are generally excludable from the child's income under the employer program. Employers also face their own cap, typically up to $2,500 per year under the employer contribution rules. Important detail, employer contribution limits follow employer plan requirements, so documentation must match the employer's specific reporting logic. Charities and other third parties may contribute, but you must track source categories and interactions against the annual cap to avoid issues. Will your financial security survive intact after taxes, timing, and the inevitable friction of regulatory compliance on this specific account?
This is exactly why I'm watching you today, so come on and quit jerking me around with the boring details.
You must balance immediate liquidity needs against reserves for a structure designed to stay locked during the long growth period. Reporting trails must distinguish after-tax deposits that create basis from the Treasury seed and employer money that do not create basis. Audit friction rises when scrutiny focuses on source of funds categories, annual caps, and employer contribution compliance in your household filing. Every dollar earned here can become ordinary income taxable on distribution, depending on basis, applicable exceptions, and future family tax brackets. Failure to coordinate this with 529 planning can result in redundant funding, suboptimal state benefits, and inefficient family cash allocation. This sequence of constraints can erode net position if you do not implement proactive controls and conservative reserve assumptions immediately.
Just tell me what the risks are before I sign anything, because I can't afford another audit from the IRS.
You risk harming your plan if you lock in capital for near-term objectives, emergencies, or sudden market dislocations. Your plan is exposed when later distributions increase taxable income and narrow planning options for the entire family unit. The absence of a Roth feature means you lose the certainty of future tax-free withdrawals that many families prefer today. Evaluate these accounts against your long-term plan to maintain a robust, accessible cash reserve alongside restricted assets. You face exposure if federal guidance evolves before your child reaches maturity, requiring annual reviews and updated controls.
Tell me what errors I might commit so I don't lose that $1,000 because I just can't lose money.
Mistake 1. Imagine you expected a $50,000 net distribution, but received far less after ordinary tax and a penalty layer. Mistake 2. You anticipated access but realized contributions cannot begin before July 4th, 2020, shifting your expected timeline. Mistake 3. You thought your employer match was a simple gift, but it created future ordinary income tax exposure you never appropriately modeled. Mistake 4. You expected Roth-like tax-free growth, but the structure is IRA-like, and the exit can be taxed at future marginal rates. Mistake 5. Your child withdrew $10,000 under pressure, and taxes plus a possible additional penalty consumed a painful chunk. Mistake 6. You calculated a strong net position, yet liquidity was lower because the asset was restricted at the time it mattered most. Mistake 7. You intended to fund education, but a 5 out of 29 plan may offer more targeted education benefits and state-level benefits, depending on residency. Mistake 8. You planned flexible allocation, but the eligible investment rules blocked your preferred sectors and strategies during key market cycles. Mistake 9. Your expected net yield looked great pre-tax, but the post-tax reality fell once ordinary income taxation hit a distribution. Mistake 10. You hoped for a simple succession, but the documentation became more complex because you must adequately demonstrate the categories, limits, and sources of funds. Mistake 11. You assumed the government seed was free money, but it creates permanent reporting and compliance obligations for your household. Mistake 12. Your net position suffered because you did not model how the basis works and which contribution types do or do not create basis.
Okay, man, just summarize everything I got to do so I don't mess up my eligibility and lose that money now.
Implement strict tracking so that every after-tax contribution is identified, because the basis affects what is taxed on later distributions. Perform monthly statement reconciliations to catch trustee classification errors before they become audit issues. Build an evidence pack. Form 4547 election, authentication records, and statements showing source categories and contribution dates. Maintain a clear separation between your personal retirement accounts so reporting remains clean and mistakes do not cross-contaminate other assets. Track employer contributions with written confirmations to prove they fit program rules and the stated annual limits. Establish a reserve for future ordinary income tax on projected gains, because this is not long-term capital gains treatment. Monitor expenses to ensure the fee structure remains within the permitted cap during the growth period for these accounts. Audit family contributions to guarantee annual limits are respected and that you can prove compliance quickly if questioned. Review state tax treatment, as federal incentives do not guarantee state conformity in downstream planning. Implement verification for third-party donations to prove the source, year, and category if questioned later. What is your withdrawal timeline, reserve rule, or contribution strategy? Subscribe, like, and share this critical wealth protection update. This content is educational only, not tax or legal advice. Regulations change. Consult a qualified professional for your situation. Would you like me to create a comparison table between Trump accounts and 529 plans to optimize your education funding?
Thanks, Tax and Borders, for keeping that bloodsucker away from Bobby's money. Now let's see what else these other videos have to say.